In this explainer video, we're going to talk about the similarities and differences of a self-directed IRA and a 1031 exchange. Let's start with the similarities. Both of these are tax strategies used by real estate investors. Similarity number two, both require a third-party qualified custodian in the case of a self-directed IRA, and in the case of a 1031 exchange, a qualified intermediary. Here at Equity Trust, we provide services with respect to self-directed IRAs and services with respect to 1031 exchanges through Equity 1031 Exchange. Now the differences. With a self-directed IRA, you have inherent tax-deferred or tax-free growth already. So if you own a property in a self-directed IRA, you sell said property, you recognize, let's say, a $50,000 capital gain. That capital gain flows back into the self-directed IRA. So as long as you follow the rules, you don't have debt financing against the property, you have tax deferred in the case of a traditional IRA or tax-free growth in the case of a Roth IRA. Now, in contrast, when you own property outside of a retirement account and you sell said property, you have capital gains exposure. So let's use the example of a $200,000 sale with $50,000 in capital gains. So if you sell the property, you have $50,000 in capital gains, you have to pay tax on that $50,000. However, under the United States Tax Code 1031, you have the ability, so as long as you follow the rules and guidelines, you have the ability to do what's called a 1031 exchange. Now you need to use a qualified intermediary, and Equity 1031 Exchange can provide those services, and you would roll the money into this specified account, and then you would acquire another property or potentially multiple properties of equal or greater value in a specified period of time. Now, do these two ever intersect, self-directed IRAs and 1031 exchanges? They do in some instances. For example, if you own a property in your self-directed IRA that has debt financing against that property, then you have what's called unrelated business income tax. So when you sell the property, you may have unrelated business income tax on the capital gains. But through a 1031 exchange, you can defer that capital gain into a property or multiple properties of equal or greater value. Again, here at Equity Trust, we provide services both with respect to self-directed IRAs and 1031 exchanges through Equity 1031 Exchange.